Right, now time to check in on those markets. Coming to you live from the JSE. Don't mind the noise that you're going to be hearing in the background. And I think it just comes with the fact that we're broadcasting live here from Sandton City, where, of course, at the JSE, we tend to have various listings going on throughout the day. But nonetheless, we're going to kick things off by looking at what's happening from an Asian markets perspective. Everybody digesting that hot CPI figure coming in at 9.1% for June, year on year, higher than the 8.6% that we saw in May. Of course, from a dollar perspective, watching that ticking up a little bit higher, the dollar index higher as well at this particular point because of investors moving towards safe haven assets like the dollar. They're moving away from riskier assets such as emerging markets, rand. So we've seen that taking a brunt of the beating, but probably not as much as we've been seeing when we look at what is going on from a euro perspective. Nonetheless, a lot of the Fed comments coming out following that hot CPI numbers, pointing to perhaps we may see 100 basis point hike at the July Fed meeting taking place between the 26th and the 27th of this month. 75 basis points perhaps, but a lot of the Fed presidents, like the Fed President Mester from Cleveland, saying that the Fed may have to take an even more aggressive stance to tackle inflation, saying that she doesn't see a peak at this particular point, or rather seeing inflation taking a turn at this particular point as we speak. Nonetheless, to talk about the latest market dynamics, we are joined by Cornette who is from Absa Asset Management. Cornette, thank you so much for your time. I mean, let's look at that market reaction for that hot 9.1 US CPI data coming in through. We saw European markets opening weaker. How are we faring right now, especially when we're looking at it from a JSE perspective?
Yeah, so good afternoon, everyone. Nastasia, as I was actually preparing for this interview, the market just continued to weaken here locally. The market, last time I looked, the all share down another 70 basis points, and that's after being down nearly 1.8% yesterday, following global markets into the red. It's really being led by the resource sector. The resources, if you look at the Resource 10 index, which is the 10 largest resource companies on our market, down more than 3%. BHP, Anglo-American, both of those deep in the red, more than 3%. The gold and the platinum stocks also very weak at this point. So generally speaking, we are just continuing our weak red streak for the week so far. The rand, again, weakening above that 17 mark to the dollar. It was at 17.13 the last time I looked. Oil, that's coming down a bit. It's still below $100 per barrel of Brent crude, at around $97, $90, $98 per barrel the last time I had a look.
So, I mean, a lot of our viewers have been hearing us talk about US CPI, inflation figures for the past few months. Perhaps we can break down the significance of this particular CPI reading and why it's so important versus the other inflation figures we've received over the past few years.
Yeah, so I think what is most important to stress is that the situation is quite dire. For the US to hit an inflation number of 9.1% for the month of July, like I did yesterday, is quite a historic event. The last time we saw inflation numbers at these levels were in the early 1980s. That's more than 42 years ago. And just to sort of explain to viewers what happened during that time is US inflation breached nearly 11%. You saw global inflation even higher than that at around 14%. You saw the US going in 2 consecutive recessions in 2 years. It had negative GDP growth for 6 quarters out of 12. You had global GDP contracting by 4.5%. And you obviously on the back of that had markets crashing. So the situation is significant, and I think we need to acknowledge that. A couple of other things which I think is important to point out is what we're seeing right now, which is different to maybe the past 30 years, is that we are seeing developed market inflation, not emerging market inflation. So in the Eurozone, in the UK, in the US, those are very big players when it comes to global GDP. So if we have a slowdown in GDP in those countries, it means that we will probably have quite a significant impact on global growth. You know the saying that says, you know, when the US sneezes, the world catches a cold. That's something to point out. Another important thing is that if you break down the inflation number that we got yesterday from the US, core inflation, so that's the inflation excluding volatile food and energy inflation, that's actually been coming down for the last 3 months. So it's down to about 5.8%, which is positive. It means that the interest rate hikes in the US, to the parts that they can control, is working. However, food inflation and energy inflation is still pressing up quite, you know, a lot higher. And those are very difficult to control with interest rate hikes. That is because of geopolitical tensions across the globe. So we might end up in a situation where it's going to be very difficult to bring this inflation under control.
We've been talking about, call it, you know, a synchronized opening, etc. And I'm wondering, how deep do you think the synchronized downturn is going to be, and perhaps where China fits in all of it all?
Yeah, so as I just mentioned, last time when we had events like this unfolding, which was back in the early 80s, global growth came down quite a lot. So I think it is fair to say, given the contribution of the US, the UK, the Eurozone to global GDP, that global growth has got to come down. That doesn't necessarily mean that all countries in the world will go into recession. In South Africa, for example, because of a very high resource market at this point, the commodity market at this point, we are still experiencing positive GDP growth. The growth rates might have to be adjusted downwards, but we're not talking recession at this point. China is a bit of a wild card in all of what's going on at the moment. You'll know that China has not really opened up its economy post the COVID pandemic to try and control the COVID outbreak in that country. And it's only just really starting to open up its economy now, which means you could have some tailwinds because of their economy opening that could bolster GDP growth in China. Similarly, the Chinese government has said that they are trying to stimulate a bit of growth in China. So there could be some monetary action there that could be contrary to the rest of the world, which is actually hiking interest rates and becoming more aggressive, where they actually want to stimulate GDP growth. So we might have a situation with China, because now, relative to the 80s, it's also a much bigger player on the global GDP front, which could buffer some of the negative impact of the US and the UK and the Eurozone.
Right. Cornette, I would have loved to talk with you a little bit more, touching on that euro-dollar parity that we've been watching over the past week or so. Nonetheless, we have to leave it there. We have run out of time with that conversation, but we'll definitely keep you posted, especially as we have kicked off US earnings season with JP Morgan reporting disappointing figures. We'll unpack all of that for you tomorrow.